Welcome to TalkTickers. We dive into earnings calls to pull out the insights you need. Today, it's Hess Midstream's first quarter 2025 earnings call. We'll break down the results, the operations, and what management's thinking about the future.
Okay, so for Q1, the headline numbers. Net income came in at $161 million. And adjusted EBITDA was $292 million.
Right, so both down a little from the previous quarter.
Yeah, slightly down. But you have to remember, there was some pretty severe winter weather that really impacted their throughput volumes.
Ah, okay, that makes sense. What did those volumes look like?
Well, gas processing averaged about 424 million cubic feet a day. Crude terminaling was around 125,000 barrels per day. And water gathering averaged 126,000 barrels daily.
So definite weather impacts there, but did they adjust their outlook?
No, actually. Despite that dip, they reaffirmed their full year 2025 guidance for both financials and throughput. And they really hammered home the focus on returning capital to shareholders.
Okay, reaffirming guidance despite the Q1 hit. That suggests some confidence, right? Either conservative planning or they expect a strong bounce back.
Exactly. It signals they're pretty comfortable with the trajectory for the rest of the year.
All right, so let's dig into that operational performance a bit more. How exactly did they navigate that weather?
Well, the lower throughput in Q1 was primarily because Hess Corporation itself produced less due to those storms in January and February.
Right.
But it wasn't all bad news. They actually saw stronger third-party oil volumes, which helped cushion the blow a bit. And then March saw really robust recovery, so some resilience there.
Okay. And what about Hess Upstream's own production numbers?
For Q1, Hess reported average Bakken net production of 195,000 barrels of oil equivalent per day.
And going forward, still sticking with the plan.
Yep, they plan to keep running that 4-rig drilling program through 2025. And they actually anticipate Bakken net production climbing quite a bit in Q2, aiming for 210,000 to 215,000 barrels of oil per day.
Wow, okay. That's a significant jump expected for Q2 then.
It is. It really highlights their expectation of recovery.
Is there anything that might, offset that growth slightly in Q2?
Yeah, they did mention that while they expect volumes across oil and gas systems to grow, they'll also have higher seasonal maintenance happening.
Ah, standard procedure though, right?
Pretty much, yeah.
Yeah.
Just part of the normal operational rhythm. On the project side, things seem to be on track. Their multi-year capital projects are moving ahead. For 2025, the big focus is finishing 2 new compressor stations and the gathering systems that go with them. And they're starting civil work on the Kappa gas plant.
And the budget for all that? Still the same.
Still projected around $300 million for the full year CapEx. So consistent investment there.
Okay, let's connect these operational points back to the financials. How did it all flow through to the bottom line beyond those top numbers we started with?
Right. So the dip in adjusted EBITDA compared to Q4, that was mostly those lower volumes hitting revenues. But interestingly, this was partly offset by lower costs and the annual rate increase they get from inflation adjustments in their contracts.
Oh, contract escalators kicking in.
Exactly. So total revenues, if you exclude the pass-through stuff, were down about $13 million, mostly hitting processing and gathering.
But what about their profitability margin? Did that take a hit?
Remarkably, no. Their gross adjusted EBITDA margin held strong at roughly 80%.
80%? Wow, even with lower volumes.
Yeah, it really underscores how profitable the core operation is.
Yeah.
First quarter CapEx was around $50 million, net interest about $51 million. That resulted in adjusted free cash flow of roughly $191 million for the quarter.
So decent cash flow generation despite the headwind.
Definitely. Profitability held up well.
And that strong margin is key. What's the financial outlook now for Q2 and the full year?
For Q2, they're guiding for net income between $170 and $180 million, and adjusted EBITDA between $300 and $310 million. So clearly expecting a bounce back, reflecting those higher volumes.
Right, as the weather impact fades.
Exactly. They do expect CapEx to ramp up a bit in Q2 and Q3, though.
But the full year guidance is unchanged.
Unchanged. Still looking at net income of $715 to $765 million for the year. Adjusted EBITDA between $1.235 billion and $1.285 billion. And CapEx, like I said, around $300 million.
Okay. And the free cash flow projection?
Adjusted free cash flow for the year projected between $735 and $785 million. And importantly, that supports their target of at least 5% annual distribution growth for Class A shares.
That free cash flow number really connects back to what you said earlier about shareholder returns, doesn't it?
Absolutely.
Yeah.
It seems to be the engine driving that strategy. Let's talk more about that.
Yeah, let's. It sounds like a major focus for them.
It really is. I mean, look at the numbers. Since the beginning of 2021, they've returned about $1.95 billion to unit repurchases alone. And on top of that, the distribution per Class A share is up around 57% since 2021. That's from a mix of their targeted annual growth and increases after those buybacks.
And how's their balance sheet looking? You mentioned flexibility.
Yeah, their leverage is about 3.1 times adjusted EBITDA. They pointed out that's among the lowest in their peer group.
So a strong financial position.
Very strong. It gives them, they estimate, over $1.25 billion in financial flexibility through 2027. And the plan is to use that for more shareholder returns, potentially multiple unit repurchases each year.
And the dividend growth target?
Still targeting at least 5% annual growth for Class A shares through 2027. And that's underpinned by their existing minimum volume commitments, the MVCs.
Right, those MVCs, they sound crucial for stability. How does the bigger picture in the Bakken play into all this?
Well, management noted the Bakken is, very operator dependent. Different companies have different approaches. Hess themselves, they're sticking with their 4-rig program. No immediate changes expected there.
And the MVCs provide a buffer.
Exactly. They provide protection through 2027. They'll set the 2028 MVCs later this year and early next. As for third parties, they expect them to be about 10% of total volumes long term, growing kind of similarly to Hess. And they're actively looking to capture more of that third-party business.
Makes sense. Leverage the existing system.
Right. And remember, those contracts, they call it toll road type revenue. No direct commodity price exposure, just fees based on volume, plus those inflation escalators targeting a 75% EBITDA margin.
And ongoing costs.
Relatively low ongoing CapEx, around $125 million a year. They also stressed that the 5% distribution growth target, they could hit that even if volumes were just at the MVC levels.
So a lot of resilience baked in.
Yeah, they see the Bakken as a premier basin long term, looking past any, short-term bumps.
It's interesting how they keep that long-term focus even in these quarterly calls.
It seems core to their strategy. Even if the basin rig count fluctuates, they're focused on the long game for themselves and third parties. Plus, economics keep getting better with longer laterals, 3-4 miles, now pushing break-evens down.
And what about the gas side of things in the Bakken? Is that growing alongside the oil?
That's the expectation. Even if basin-wide crude production kind of flattens out eventually, gas production is likely to keep rising as wells get older. Hess expects its own oil to grow, but they see their gas volumes rising too, fitting that broader basin trend.
Do they have the capacity to handle more gas?
Yeah, they mentioned having flow assurance for gas egress, and they're a shipper on the Bison Express pipeline, which adds flexibility.
Okay, one last check on capital allocation. That $1.25 billion in flexibility, where's that coming from exactly?
Good question. They estimate it's roughly half from leverage capacity. They see leverage dropping below 2.5 times by the end of 2026, and the other half is expected from growth in excess free cash flow.
And the pace of buybacks? Consistent.
Well, historically, it's been around $100 million a quarter, but they did say the timing and amount can vary.
Yeah.
But the key takeaway is they still expect multiple repurchases per year through 2027.
All right, that brings us to our This Is Not Financial Advice segment. Time for some, let's call them outrageous but plausible trade ideas based on this call.
Okay, idea one. Given Hess Midstream's strong focus on shareholder returns, that low leverage, and those solid MVCs, you could consider a long position in Hess Midstream itself. Maybe pair it with shorts in some midstream peers that have higher debt or aren't returning capital quite so aggressively.
Kind of a relative value play within the sector.
Exactly. And that Q1 weather dip might be an interesting entry point before the Q2 volume recovery really shows up in the numbers.
Okay, interesting angle. What's number two?
Number two focuses on the gas side. We heard about the expected growth in Bakken gas production, right?
Even if oil plateaus.
Right. And Hess Midstream is expanding its gas processing with the CapOp plant coming online eventually. So consider looking at long positions in companies that specialize in NGLs, natural gas liquids, processing and transport within the Bakken.
A sort of leveraged play on the rising gas volumes.
Yeah. If gas production increases, those NGL specialists could see higher demand for their services, potentially offering a different way to play that trend.
Some creative thinking there. Okay, that wraps up our deep dive into Hess Midstream's Q1 2025 earnings call. We've hit the financials, the operations dealing with that weather, their becking outlook, and that big focus on shareholder returns. Hopefully this gives you a much clearer picture of where they stand and where they might be headed, what stood out most to you from the call. And just a reminder, as always, those trade ideas are purely speculative, just food for thought. This is definitely not financial advice. Please always do your own thorough research before making any investment decisions. And we absolutely encourage you to check out the full earnings call transcript and slides yourself for the complete picture. Join us next time on TalkTickers for another deep dive into the earnings calls moving the market.